Okay, we now move to the overview of private equity, and this is part of the portfolio risk or the investment risk part or investment risk management part. What we need to understand here is the structure of private equity investing, how it is capitalized, and how it has changed since the credit crisis in mid 2007. We need to be familiar with how private equity portfolio company is capitalized and also understand the various incentives in place for general partners and target company management. Finally, we need to know the difference between broad types of private equity, that is leverage buyout, growth capital, mezzanine capital, and venture capital. So let's start with it. The types of private equity investment, and there are four types. We'll look at differences of the four. So first is leverage buyout. An LBO is an investment group purchases a firm. In an LBO, an investment group purchases a firm or a business unit using large amount of debt. So as the name suggests, its full form is leverage buyout, and the use of leverage is the main differentiator here. An ideal target has got a lot of free cash flow. After the LBO firms sell parts of the business and try to raise cash to pay down the debt. Now the second is growth capital. There are minority equity investment in established firm that need additional capital to expand, restructure or acquire a business. In a growth capital investment, there is no change of control. Then we have mezzanine capital. Mezzanine capital is an investment in subordinate debt or preferred stock in a firm. There is again no change of control. These investments usually have attached warrants given the investor the right to purchase common stock. Then we have venture capital. They are investment in startup or less mature non-public companies to finance launch, expansion, early stage, and so forth. So these are the four types of investment. Now let's understand private equity fund structure. The basic structure of private equity fund and its source and uses of cash. A private equity firm is a holding company for a number of private funds which are run by general partners. The general partners invest and also secure investment from limited partner institutions or high net worth individual. As a general partner, the private equity firm receives an annual management fee, which is usually 1 to 3% of the fund's asset under management. The general partner also receives carried interest, which is usually 20% of the profit. The balance of the portfolio is paid out to limited partner. The private equity fund is defined by a partnership agreement between the general and the limited partner who is signed at the outset. Generally, a new private equity fund is raised every 3 to 5 years and usually invested within 5 years. It is anticipated that the exit strategy will occur within 3 to 7 years of the first investment. The peak period for the private equity LBO was 2002 to 2005, beginning mid of 2007 when there was credit hit. The nature of private equity transaction changed. There was slightly less debt involved, more equity contributed to deals, less attractive debt terms, fewer transaction, longer holding period. With these changes came lower risk and lower return. Now let's describe the private equity fund of funds and secondary market for private equity. The private equity fund of fund obtain investment from individual and institution and spread investment among various different private equity funds. The advantage for the investor is to access selected private equity manager that they might not have access to otherwise. Also, fund of fund manager performs a significant amount of due diligence. This is very same to the fund of fund that we studied in the hedge fund. Private equity secondary market. Sometimes investors wish to sell their private equity. Financial institution may wish to rebalance their portfolio to reduce risk, or individual institution may similarly need to sell variety of for a variety of reasons. In secondary market, seller can transfer a limited partnership interest and will continue undisturbed. A seller can transfer a portfolio of private equity management in operating companies When a limited partnership interest in private equity fund is sold, both the investment in the fund and the remaining unfunded commitment are sold as well. Generally, any sale has to be approved by the general partner. Many transfer are not desired because fund does not want to be reclassified as publicly traded partnership that would be taxable as corporation. Seller can be classified as distressed investor, quasi distressed investor. Now, distressed investor are banks, insurance firms. Quasi distressed investor are fund of funds, hedge fund. And other seller who are not distressed, like endowment, may change their market view or wish to diversify the investment portfolio. So, special investment funds may be established with the purpose of purchasing other private equity interest in the secondary market, perhaps at bargain price. Now, private equity characteristic. Key characteristics of private equity transaction. A private equity investment funds has secured debt and equity funding typically from institution, investor or pension funds. But source of capital investment can also include insurance fund, endowment, fund of fund, higher net worth individual. Sovereign wealth fund, hedge fund or even banks may also make a private equity investment. The transaction involve high level of debt and the firm with good cash flow are targeted so that debt can be paid off quickly from operating earning and also sale of portion of business, excess assets and so forth. The equity portion of the investment is generally 30 to 40% of the purchase price and the rest is debt. Different levels of debt include senior debt provided by bank and secured by the firm asset and also the subordinated debt which is unsecured. The type of high yield debt is raised in the high yield capital market. If the target is publicly traded, the buyout will make it public. The goal is to restructure a firm and bring it back in public in 3 to 7 years. In a private equity transaction, the internal rate of return is over 20%, but this is dependent on the degree of leverage and the ability of the firm to pay down its own debt. General partners are incentivized to make the transaction work with typically 20% of the profits and they work alongside limited partner. An ideal private equity transaction will involve highly motivated management, strong cash flow, a balance sheet, and this can be further leveraged. Low capital investment, good quality asset, situation in which asset sale can be realized and cost cutting can be performed. There are variety of participants in these private equity transactions, including the private equity firm, investment banks, high network investor, institutional investor, management of firm, assortment of lawyer, accountant, and tax report. Private equity participants. Identify the key participants in a private equity transaction and the roles they play. Now, private equity firms, the entity selects the LBO target with the input from the investment bank hired. The private equity firm negotiates the price and arranges the financing. The firm then oversees the management of the firm and will take place on the board of directors. The firm makes all the major financing and strategic decisions and put together with the assistance from the investment bank the exit strategy. Investment banks help select the target investment, helps negotiate the price and structure the entire transaction, underwrites the loan and participates in syndicated bank loan facility and occasionally helps the recapitalization of the firm. The investment bank will form with the private equity firm on exit strategy. Will work with the private equity firm on exit strategy and also can underwrite debt or provide large dividend for the private equity firm. The fees earned by investment banks are substantial. Investors, high net worth and institutional investors participate in investments as limited partners and sign investment contract that can lock up funds for 10 to 12 years. Limited partners agree to contribute capital over time and it may be years before all the limited partners are drawn down. The goal is implementation of exit strategy at which point any investment is turned into cash. Management of the target firm may co-invest with the private equity fund and receive stock options which provide incentives to be successful. Generally, a successful exit can happen within 3 to 7 years of the acquisition. If the thing does not go back, the option will expire worthless and the management may be fired. Lawyer, accountants and tax expert. Many professional services firms such as lawyers, accountant, tax expert work closely with private equity firms and investment banks to provide advice and assistance on a variety of private equity investment. Now we look at funding private equity transaction. Identify and describe the methods of funding private equity transactions. A private equity transaction is typically a transaction involving a company or a business unit. It is acquired with debt secured by a company's own asset, along with the equity funding from the general partners, which is the private equity firm, and limited partners, which is institution, high net worth individual, endowment, fund of funds, sovereign wealth fund, hedge funds, or even bank. Equity investment is usually 30 to 40% of the purchase. The balance of the cost of the equation comes from various type of debt, including collateralized bank borrowing through revolving credit facility, term loan, mezzanine debt, and even high yield bond issued in public market. Debt level in these transactions grew higher and higher through mid 2007 but has decreased a bit after the credit crisis in 2008. The next topic is identify uses related to interaction between private equity firms and management of target company. Now, ideally, the private equity firms will make an agreement with management allowing them to participate in eventually success in the transaction. The participation can be in the form of post-closing option grants or rollover equity, which is the amount of stock that management must purchase in order to participate in the transaction. Teaming with management is a bit tricky because the target firm's board may have its own actions scrutinized and their actions may become subject to the entire fairness test. The firm being acquired must be careful that the transaction is fair to the shareholder. What must be avoided is a transaction where private equity firms team up with a controlling shareholder or even the CEO. This may be perceived as disadvantageous to the shareholder. There is no clear definition of controlling shareholders. It could be 40% of shareholder or even smaller percent. If in fact the fairness of transaction is challenged, the burden proof is on target firm. The board of directors of the target firm may set up a special committee to examine the fairness of transaction in order to forestall any challenges down the road. In addition, the private equity firm teaming up with the management can possibly trigger a target firm's takeover defense, such as poison pill, if the firms own more than 50% of the target firm's stock. Private equity firm also must be careful with disclosure. There is a pre-signing arrangement with management. The SEC may require early disclosure of the transaction. The transaction may be also somewhat termed as management buyout (MBO). This is where management takes the lead and orchestrates a private transaction. This can be complemented because management investing horizons may be longer than the private equity horizon. Both parties need to align their return objective. Now, capitalization of a private equity portfolio company. Describe typical ways of capitalization of a private equity portfolio company. The primary component is debt, comprising of 60-70% of the overall capital structure. This debt could be of various type. The first type is senior bank debt revolving credit facility. It is borrowed against or paid down and re-borrowed as needed. Senior and subordinate term debt. This is a typically carries a floating rate. Then we have junior debt, which is high yield debt issued through capital market. Then there is junior debt, mezzanine debt. They are typically subordinate notes sold to banks, institutions, and hedge fund. The junior debt can incorporate features including a warrant and a pay-in-kind toggle, allowing for increase in principal with no interest payment. The remaining capital structure is equity, comprising of 30 to 40%. It can be in a form of stock or preferred stock. Now, describe the potential impact of private equity transaction, including leverage capitalization on target companies. The leverage capitalization of a private equity fund portfolio firm is when target companies issue a large additional amount of debt at a time when the acquisition is completed in order for private equity fund to receive large dividend. This enhances the private equity return but put additional stress on the firm, making the debt increasingly risky due to high interest payment and fees. The firm's existing debt can decline in value because the firm's overall risk is high. The leverage recapitalization can also negatively affect the equity holders and even the target firm's community. If the firm fails because of its inability to make increased debt payment, jobs are lost and communities negatively impacted. Communities can lose significant tax base. So let me revise the major points that we talked about. The leverage recapitalization of a private equity fund portfolio is when target company issues large additional amount of debt in a time after the acquisition is complete in order to private equity firm to receive large dividend. So that's leverage recapitalization. This can put stress on the firms and make it quite difficult to the firm to make debt payment. This can create ripple effect and can impact community, employers, and everybody. So that was all on the private equity. I hope this added something to your knowledge base. Thank you for listening.